Hello, welcome to this session. Today we're going to talk about depreciation. Depreciation is part of chapter 10, which is one of the chapters we are assigned to read this week. Let's dive into it. What is depreciation? Depreciation is the process of allocating the cost of plant asset to expense while it's being used by your business. Depreciation does not measure the decline in the asset's market value or its physical deterioration. It's just the process of allocating the cost you paid for the asset over the period of time that you expect to use it in your operation to generate revenue. Okay. What are some of the factors to consider when you calculate depreciation? The first one is cost. We have cost of the asset. The cost of the asset consists of all necessary and reasonable expenditures to acquire the asset and prepare it for its intended use. If you have to pay, for instance, the transportation cost, you have to pay for any programming cost, any insurance while the asset is being transported to your place of business. These are considered part of your asset cost. So you need to include those in the calculation of depreciation. The second factor is salvage value. Salvage value, also called residual value or scrap value, that is an estimate of the asset's value at the end of its useful life. This is the amount the owner expects to receive from disposing of the asset at the end of the asset's useful life. Okay. The third factor is the asset's useful life. Useful life of a plant asset is basically the number of years that you expect to be using the asset in your business to generate money. Okay. The next item we're going to talk about is the methods of depreciation. We have three methods of depreciation we will talk about in this presentation. We have straight line, and we have units of production, and we have declining balance. Let's look at each of these separately. Okay, so now let's take a look at the calculation of this straight line depreciation. How do you do that? Well, let's assume, for instance, your cost of the asset is $10,000. And remember what is included in the cost of the asset? It's not just what you pay for it, not just the purchase price, but it is all the expenses, all of the costs that you incurred to bring the asset into your place of business. Programming, insurance, transportation, taxes, all of that. And you deduct the salvage value from that. Remember the salvage value, which we also call residual value, and you take that, you deduct it from the cost of the asset, you get 9,000, and you divide that into the by the useful life, which is 5 years, you get $1,800 per year. Remember, this is the amount, exact same amount you're going to be booking to expense for the next 5 years in which you expect to be using the asset to generate revenue. Remember, the straight line depreciation gives you the exact same amount every single year. The second depreciation method we're going to look at is the units of production method. In this one, we have two steps. The first step is you take the cost of the asset and you subtract the salvage value, which you also call residual value, and we divide that by the number of units of production. The second step, you take the depreciation per unit that you calculate in step one, and you multiply that by the number of units you produce in the period. Let's take a look at an example to illustrate that. So you have an asset that you purchase. Total cost of the asset is $10,000. And again, remember, the total cost is everything we talked about, not just the purchase price. And that is important. Okay. You deduct the salvage value, you get $9,000. You take $9,000, okay, you divide that by the total expected units of production, which is $36,000, 36,000 units, and you get a depreciation per unit of 25 cents per unit. In step two, you calculate the depreciation expense by multiplying the depreciation per unit, which is 25 cents, by the number of units that you produce in the period, and that number is 7,000 units. You produce 7,000 units in this period, and you say, okay, let's multiply 7,000 units by your depreciation per unit cost, which gives you $1,750. Notice when we calculated the straight line depreciation, we came up with $1,800. That was going to be the depreciation expense for the month under the straight line method. As you can see, it's about $50 less using the units of production method. And what I would like for you to remember here is that the straight line depreciation, as I mentioned earlier, it gives you the exact same amount. That amount does not change from month to month, but the units of production is a variable amount because it changes based on your production. For instance, you produce 7,000 units this time, your cost is 1,750. If you produce 6,000, your cost is going to be slightly less, and if you produce 8,000, your cost would be more. So variable, the units of production method gives you a variable amount per month, where the straight line gives you a straight amount every month. Okay, so last depreciation method is the double declining. Very simple, but we have three steps to go through here. Again, we're going to be using the exact same example we had earlier. Cost of the asset of 10,000, residual value 1,000, useful life 5 years, and number of units expected 36,000 units. We're not going to be using all of this information, but let's go through the steps. The first step in calculating the double declining is to calculate the straight line rate. How do you calculate the straight line width? You take 100%, you divide that by the number of useful life, which is 5 years, you get 20%. In step 2, you basically take, you calculate the double declining balance rate. What do you do? How do you do that? You take the straight line width multiplied by 2. You get 40% in this case. So in the last step, you just basically take your double declining rate of 40% and you multiply that by the asset cost. As you can see here, we do not use the salvage value. That's the one method that does not use the salvage value. You just go straight with the cost of the asset. And again, I can't stress that enough. The cost of the asset includes everything, not just the purchase price. But anyway, you multiply the cost of the asset by 40%, you get $4,000 for the depreciation. Next year, you're going to be taking the exact same 40%, but you're going to multiply it by the cost of the asset at the time, which will be 6,000. So double declining gives you a much higher expense amount in the earlier years of using the asset. As you can see, it's more than double the straight line depreciation. Because remember, straight line depreciation amount was 1,800, right? This one is 4,000. So what will happen? The next year, when you depreciate, you'll get a much smaller depreciation amount, but this double declining gives you a higher depreciation expense at the beginning, but towards the end of using the asset, you get a much smaller depreciation amount. That's all I had for you today. Again, if you have any questions at all, send me an email or send me a CTU message on the portal, or send me a text. I will see you in the next class. Bye.